Yo, welcome. So today we're talking on equilibrium on discount. So equilibrium is the midway point of a range. You know what a range is already. So equilibrium is the midway point of a range. So when the market is in equilibrium, we know the price is fair. It's actually a fair price. So market usually balances itself when it comes to equilibrium. So today we're talking on equilibrium and discounts. If the price should be at $10 and it goes below $10 and someone sells to you at $8, meaning you're buying at a discount. So if the fair price of that market is $10 at the equilibrium and it goes below $10, the person sells for you for $8 or $6, meaning you actually bought at a discount. All right. So this is the price range from this low up to this high here. You can see it's a price range. This point here, this green line here, let me indicate properly, is actually the equilibrium. This black line now is the equilibrium of this price range from here up to here. So usually the market will come down to the 50%, which is the equilibrium here. It shows that the price is balanced. So when the market moves higher and retraces back to the 50%, or to the discount. Anything below the 50% is a discount. So as I say that 50% is a fair market, the market is balanced. When the market returns back to the range, it's balanced. So whatever you buy below it is at discount. You are buying at discount price. Alright? Okay. So when there is a run and the market start retracing back. So once you see the market start creating the fourth candle after the 3 bar swing, then you know the market is about to retrace down. So let's take a look now, closer look on it. All right, so this is the bullish market. You know your market is in the bullish trend, so that's what we're working on now, a bullish trend market. All right, so going to draw this thing and make it look better now, so you can actually see what I'm saying. All right, so this is a Fibonacci I'm actually using to measure the 50% of it. Fibonacci retracement. Okay, let's get a better picture now from this price run from here. All right. So just always look for the 50% of it. So after a market makes a run higher and begins to retrace lower, look for a drop below equilibrium. So when the market moves higher, from this point here, the market moves higher. So immediately it starts to retrace down. We look for 50%. So I'm going to place my fib at this point. The market started going down. So let's work with this price range for now. All right, you see, the market came exactly at the 50%. Market came to equilibrium and moved higher. All right, so you can see, place your feet below. All right, so you can see now. You know your market wants to start retracing down after it makes the 3 bar swing. So I'll wait for the first candle, the middle candle higher than the first and the third candle, right? So if the fourth candle closes below the middle candle that made high here, if the fourth candle closes below, I'll be expecting the market to come down to the 50% or to the discount. So anything below the 50%, you're buying at the discount, all right? So now let's market move down from this price range here to here, all right? So we can take that further. When the market moved, broke this high, moved, it created a new high here, right? So we can move our Fibonacci now to this point here, right? Okay. All right. So let's take it to the new price range. So this is a low, right? All right. So now the market came below. Let me increase it so you can see. So the market came below the 50%. I'll draw a line that shows the 50%. So better. So this is the area here. So this is the 50% of it. Now the market came below the 50%, went into equilibrium, it went into OT, optimal trade enter, right? So now it's inside the discount. Now you buy at the discount, right? So see the 50% where you use this range from here, this range, this high, this low to this high. Let me take it to the exact point of it, sorry. Alright, so now the market came down into equilibrium, right? So it dropped down to discount point of it. So now you buy at this point. So this is a daily time frame you're working now. When I see my market drop down into equilibrium, I go to my lower time frame to look for a perfect entry. I'm not actually giving you a way of entering the market now. I'm not telling you buy at this exact point or so. But you know when the market drops down to equilibrium or discounts, go into your lower time frame. That will be a class for another day. So you know when to buy and in your lower time frame. All right, so I'm just showing how the market works now. This range line, the market went below the equilibrium area and moved down to the discount area. All right, okay, so that is the range. Sometimes you might ask, let me take it to a point where sometimes, so when the market, we can expect, let me take it back, we can expect to put our stop loss at the low of the range at this low here. We're not expecting the market to come and run down this low, right? Because this is our range point. But sometimes the market actually goes down below that low and runs it out. If it runs this low out, you should know the market just going to take out liquidity. It's not going to waste time there. It moves up. So sometimes when your market moves below 79%, you're expecting to buy after the market runs out the low. So you could place a buy limit below it here. All right. So okay, that is when you know your market is still in a bullish trend. It just comes down to run the low out. All right, so you know you buy when your market is in the discount area, right? On our next class, we'll talk on premium also, equilibrium and premium. So this right, we are focusing on equilibrium and discount actually, right? So you work with your range, all right? Remember, this is the low we started with, right? So I'm just showing you how you can continue following the trend using the frame range that you see on how to enter your market. All right. Sometimes it doesn't come to equilibrium. What happens? You leave the trade. You don't force it. Sometimes you wait and wait and wait. So when you see the range, this range that we use first and this high now, if the market is dropping, you do nothing. You just wait patiently for it to get to equilibrium and drop into discount before you buy. Right? So you just patiently wait. Sometimes it never gets there. For example, all right, let's check something here now. This low. Let's use this high for now. This high. You could see the market retraced down, then moved up. It never got to the 50%. But this would be where we are patiently waiting for the market to get to like this is our 50%. We should be patiently waiting for the market to drop down into this area before buying. But the market never got to that point. Alright. Okay. So let's move. Now let's use this order price right now. Work on this high here, right here. Sorry for my throwing. Right. This high here and I'll work with this range. So work with this low right here, right? This low here is kind of small. Alright. So remember when our fourth candle start moving down, we're expecting it to come below. So I'll work with this low up to this high, expecting the market to come to the 50%. Oh, it took out the low, right? So I told you it won't waste time. At some cases, you should lose money at some cases. So your stop loss would have been here and you lost. All right. So there's no big deal. You shouldn't panic. It's the game you lost at some time. All right. But you see, the market did not waste time after taking out the slow. Merely took out this liquidity here, move, shut up, right? Okay, so that is it. All right. Okay. Since you know your market is in a bullish condition, whenever it comes to take out a low, the market doesn't stay there for long. It quickly moves up, right? Okay. Same thing happened there. I could put my, this is a range, and this is a range also, right? So I'll be expecting it to come to the 50%, but you see, with your eyes, you could know that the market left the 50%. Now, took out the low, right? It took out the slow here over here. So I'll put the drawing over there now. See the low? All right. So it quickly left that area after taking out the low. It quickly left the area, all right? So that is it. So now you're expecting to buy at your discount. All right. So after you move higher, you expect the retracement to begin. After the first, second, and third candle was closed as a bar, as a swing high, and the fourth candle did not go above the swing high, you're expecting a retracement down to your 50% or your equity or discount. All right. Then you go to your lower time frame to start expecting an areas to buy, maybe your favorite gap or your other block. So we'll talk about all of those later on. Okay. So that is how a range works. All right. So I believe you understand. You can drop a question later. All right. Just marking with that range and expecting your market to drop down. So after a market makes a run higher and begins to retrace lower, look for a drop below 50% of the price. All right. So a drop below the 50% or equilibrium indicates that price is now in a discount. So this frames the ID buy setup, right? It will frame the buy setup you're looking for, right? So when your market is in discount, you start looking for how to buy. Okay, buy at discount, right? So that is it. All right. On our next class, we'll talk about premium also. So just go through and since you understand what the range is actually, it's just a market dropping into the midpoint of that range. So that's where you're expecting to frame your buy setup, right? Then you go to your lower time frame and look for other confluences that will make you buy at that area. Okay. All right. Maybe I should do a little drawing for you. Okay. So this is a price range from this high. Right. Right. So okay. Now we're expecting this market now to drop down to equilibrium, right? So let's measure with our eyes. You can know this is more than the 50% already. All right. All right. So sorry for that. It's okay. All right. For example, now. All right. Sorry for my drawing. It's not looking good. Okay. But now let's measure with our Fibonacci here. So this is our price range here to this high. All right. So now using our Fibonacci, we are actually checking for the range of price. Okay. So if price drop down into this 50%, right? Down to this discount area, right? So this is the area we're using as a 50%, right? Now see, price went down into discount, then moved higher, right? Okay, that's what you should do. So this frames your buy setup. Now, when your price comes to the equilibrium area, into the discount area, you frame your buy setup, looking for other consequences that should make you buy the trade. All right, I believe that's it for now.